dollars invested each year in a tax-deferred investment plan at 15% for 20 years would grow to $117,810. Recently, while I was on a radio show exposing the ills of the whole life insurance industry, I got a call from an ex-whole life salesman who told this story. He said, "When I was young and less wise, I became a whole life salesman for a major insurance company. My second month, I sold a whole life policy to a young couple in their early 20s with 2 small children. The premiums were high, but the amount of insurance was only $20,000 because the majority of the premium went to build the so-called cash value." He went on to say that 3 years later, the husband, who was the insured, died in an automobile accident, leaving the kids with no father and the family with no income. When the wife turned in the insurance claim, she received $20,000, but of course, not a dime of the cash value she was supposed to be accumulating. The money barely covered the funeral arrangements and a few months of family expenses. "I realized," he said, "that had I done what was good for the family instead of what was good for me and the insurance company, I would have sold that family a term policy. For the same exact premium, I could have sold the family almost $1 million of life insurance with no artificial savings plan, and the wife and children would have been taken care of financially for the next 20 years or more." This experience, he continued, shook me emotionally so badly that I quit the life insurance business forever. I honestly felt that because of my knowledge and their lack of it, I had stripped this family of the protection and help they really needed. Need I say more? Don't make the same mistake. Divide your life insurance from your investments and use your life insurance dollars to buy the maximum necessary protection for those you love and need to protect.
Strategy 316. Don't fall for the biggest lies about whole life insurance.
Here are some of the biggest lies that life insurance salesmen tell, either on purpose or because they don't know the difference themselves. First, you may have heard this one. You can borrow your cash value for only 5% to 8% interest. What a benefit. The insurance company is charging you interest on your own money, which you overpaid in premiums, and then reduces your death benefit by the amount you borrow. Your policy will eventually be paid up. In reality, a paid-up policy is created only by overpaying your premiums. That's the only way it can be done. Your overpayment eventually pays your future premiums. Therefore, all paid-up policies are just prepaid policies, and you've lost the use of your own money. You'll be earning interest. Whole life policies pay an average of only 1.3% interest. Who decided that? The state insurance commissioners in a study they did years ago. Worse yet, you never receive the interest. The interest earned is added to your cash value, and you already know that you don't get the cash value. Your insurance policy is a tax shelter. You are told that life insurance enjoys some special tax status. For instance, you can borrow money from your insurance policy tax-free. That is true. However, you can borrow money from anywhere tax-free. Now, it is true that the earnings that you have compound tax-free, but the earnings in an annuity, which you'll learn about later, also compound tax-free, and the annuity is by far a better investment than whole life insurance. If you buy life insurance when you're young, it will cost less. What a joke this one is. It is true that yearly premiums are less when you're younger, but only because you're going to pay a totally greater premium over a longer period of time. The only reason to buy life insurance when you're young is financial protection for your family, not because you're going to save money. An analogy would be a car salesman telling you that it's better to finance a car for a greater number of years because your payments are less per month. Sure, they're less, but overall, you pay far more.
Strategy 317. Don't buy life insurance to avoid the threat of being uninsurable in the future.
Because a life insurance policy can be canceled by the company only for non-payment of premiums, Salesmen often use the threat of future uninsurability to get you to buy an outrageously priced policy. The truth is that about 97% of all those who apply for life insurance are accepted, and approximately 5% are charged extra because they are already in poor health when they apply. Remember that all insurance is a bet, and in the case of insurability, the odds are already overwhelmingly on your side. The question of future insurability is a scare tactic used by salesmen for the purpose of selling you more insurance at an earlier age. Universal life is a term insurance policy coupled with an investment plan. The investment can pay a fixed interest rate, or in some cases, can be self-directed into mutual funds. The cost of insurance and fees and commissions are deducted from your premium, and only the balance goes into the investment. Universal life insurance makes a poor plan for many reasons. Number one, you are not paid the 8% to 10% claim by the company. Number two, the fees and commissions are far too high and can increase during the period you're paying the premiums. Number three, there is a huge surrender charge if you change your mind. Number four, the face amount is usually guaranteed only for 10 years. Later it could be changed by the company, causing you to pay higher premiums per $1,000 of insurance. Here's a good example. A 45-year-old man buys a universal life policy combining a $100,000 death benefit with an investment promising a yearly return of 10% for 20 years. He pays $2,000 in premiums per year, or $167 a month. Now here's the trick. He is paid the 10% only on the money that goes into the investment. That is, what is left from the $2,000 premiums after the fees and commissions, and of course the cost of the insurance itself, are deducted. In a typical universal life policy, the first year's fees and commissions alone can amount to $600. Therefore, in our example, this person loses 30% of his $2,000 to fees and commissions. About $300 covers the insurance on his life, so only about $1,100 the first year goes into the investment to earn the 10% claimed by the company. The actual yearly investment return on most universal life policies is less than 6% for the first 10 years. Some investment. Each year in a universal life policy, the cost of the insurance increases, further reducing the amount that goes into the investment. But you never see it happening because your premium remains the same. The high surrender charge penalty is the insurance company's method of making it impractical for you to change your mind and drop the policy. Those companies that charge the least in front-end fees usually have the biggest surrender charges. Is there such a thing as a good universal life policy? Look in your manual, and I'll show you how I've designed what would be in a universal life policy if there were such thing as a really good one. So far, none have met